All right, welcome back. Defining profit. So welcome to Unit 3. In this video, you will learn how to calculate profit, as well as the difference between two different types of profits, accounting profits and economic profits. All right, so what is profit? Profit's really simple. Total revenue minus total cost. So again, total revenue, that's the price times the quantity of the goods. So if we sell 10 goods and they each cost $5, our total revenue is $50. If it cost us $45 to make those goods that we had to pay to workers for wages and for capital, things like that, we do 50 minus 45 equals a $5 profit. So that's pretty simple. We're going to get into a little bit more detail in the coming slides though. All right, so looking at cost a little bit more specifically now, we're going to contrast two different types of cost, explicit and implicit. Explicit costs are the costs that we're used to thinking about. They are costs that require you to make a payment. So there is a dollar amount attached to them. So you have to pay somebody money. So when you pay a worker their wages, when you pay the landlord the rent for the building that you're renting from them, when you have to rent or buy the physical capital, the machines, the technology, the tools that your workers are using, when you have to pay for the raw materials or the inputs, all these things are explicit costs because you have to take money out of your pocket or you have to write them a check or send them money electronically. So those are explicit costs. On the other hand, and this is what's new to people typically, is that there are also things called implicit costs. Implicit costs do not require you to make a payment. So there's no money changing hands with an implicit cost. You don't write anybody a check, you don't wire anybody money, nothing like that happens. Rather, what an implicit cost is, it's the opportunity cost of using resources that are owned by the person or the firm. So what we're talking about here is, so you see the analogy of the iceberg, the explicit cost where you can see on the outside because you can count up, all right, these are their costs they have paid to workers and for labor, etc., etc. Implicit cost we don't really see. Remember what opportunity cost is. It's talking about our next best option. So, for instance, instead of starting your company, you could have gotten a job and gotten a salary of a certain amount of money at a different company. That's part of your opportunity cost for starting your own company. So let's say that instead of starting your company, you could have worked for Google and Google would have paid you $80,000 a year. Well, that's money that you're giving up because you are now not earning that $80,000. So economists look at that as an implicit cost because at any time if you shut down your business, you could earn $80,000 a year working for Google, for example. Additionally, if you own machinery, so you own some of that physical capital, that's money, again, that you could have rented that equipment out. If you own the building that your business is in, you could have rented that out to another business and you could have received that rent in the form of income as well. So you're giving up the income that you could have earned working at a different job. You're also giving up the income you could have earned renting out the things that you own. So we measure implicit cost by the dollar value of these benefits that you have chosen to forego. So again, with implicit cost, there's no money changing hands. It's money that you could have earned if instead of making this firm or this business, if you had done your next best option. And so you add up the value of that next best option, your salary, any capital or buildings that you could have rented out, and we add that as an implicit cost. All right, so this is just specifically defining implicit cost of capital. I just defined this one though. So it's the opportunity cost of the capital used by a business. So it's the income that you could have earned from that capital if you'd used it in its next best way, which in this case means instead of you using it for your business, instead you would rent it out to somebody else. So we have something called the rental rate, which I don't think we're going to get that detailed in this class. But the idea is if you could have rented that machine out for, let's say, $50 an hour times 8 hours a day, you know, for whatever, you could do that math and figure out, all right, that's the opportunity cost of you keeping that machine and using your own machine. So that's, again, it's a weird concept sometimes. There is an opportunity cost to you using your own machine that you earn because you could have rented out to somebody else and earned income from renting it out. And so that money that you could have earned, that is your implicit cost, in this case, of capital specifically. All right, with those two things in mind, thinking about explicit and implicit costs, we're going to have two different types of profits: accounting profits and economic profits. Accounting profit, that's what we're used to thinking about. Total revenue minus explicit costs and depreciation. So this is how an accountant would think of things. So if you had an accountant and they were looking at your business, they'd want to know how much have you paid, your explicit costs. So how much did you pay for labor, how much did you pay for capital, how much are you paying for rent. They would add those things up, and then they'd want to know what's your total revenue, and they would take total revenue, they would subtract your explicit costs, and that would be your accounting profit. That is how most people think of profits. So when you just do total revenue and explicit costs, that's your accounting profit. Now, depreciation is in there as well. Depreciation refers to the loss in value of the capital that you own. So as your capital, your physical capital gets older, so as your machinery gets older, it starts to break down. It becomes less valuable in general because it's older. Just think of like a car. If you were to buy a car, it depreciates as soon as you drive it off the lot, right? It's the same idea with machinery. As it gets older, it works a little slower, it's not as good, it needs more repairs, it becomes less valuable, so that is going to be subtracted as well from your accounting profit. So I think most test questions are probably just going to focus on total revenue and explicit costs, but if you do see depreciation, that's what it's referring to, the loss in value over time of your physical capital. All right, now economic profit, obviously in an economics class, this is the one that we're going to be most concerned with, as well as contrasting it with accounting profit. Economists, obviously because we think opportunity cost is hugely important, we are going to care about both the explicit and implicit costs. So for economic profit, it's going to equal total revenue minus the opportunity cost of its resources, which are both the implicit and explicit costs. So if you wanted to write in your notes, probably the best way to write this is economic profit equals total revenue minus implicit and explicit costs. And you see again that side by side comparing how economists look at profit versus how accountants do, because there is definitely a difference. Accountants look only at your explicit costs, whereas economists look at both the explicit and the implicit costs. And finally, we have a term, a normal profit. This is something that is going to be expanded upon greatly, not just in this unit, but future units. Economists would call a normal profit an economic profit that is equal to zero. So this is where your explicit and implicit costs add up exactly to total revenue. This is an economic profit that is just high enough to keep a firm engaged in its current activity, meaning that they don't have a better option. That's going to be what is considered a normal profit. If your economic profit is greater than zero, then you're earning a positive economic profit. Normal profit is zero, and economists would say there's nothing wrong with earning a normal profit because you can't do any better, so that is an efficient outcome. This has been a LaMoney production.